We are back with you. I'm Marlin, Bohling, your tour guide to the ag commodities. Well, here it is Monday, and we're watching our ag trade, and it just seems like it's trying to find its way today. Now, this morning, USDA announced that we actually had an overnight export sale. In this case, I guess you would say it was over the weekend. It was soybeans once again, the amount, 132,000 tons, and it went to unknown destinations, so no definitive case of what the destination is this time around. Everyone suspects it may be China, and they like to buy in that amount, but can't say for sure just yet. However, everything opened with a softer tone this morning, and let's take a look at our corn trade in our quotes provided by bar chart. I'll show you what I'm talking about here. December down 4.5 cents at 568.5, so it's not doing too much of anything right now. If you look at the soybean trade, it had been trading higher in the overnight Globex session. Then we opened up this morning after we got the export news, and it opened a penny lower. Well, now November soybeans are trading to higher at 13.67. So basically, it's almost like it's treading water here today. All right, let's move on and check out our Chicago wheat, and we have December trading 4 3/4 higher. We're now at $7.79 per bushel, still about a nickel away from our high. If you look at Kansas City, it's on the downside, but not very much, down 3/4 cents. We're at 7.54 1/4 right now. Meanwhile, in Minneapolis, we now have December trading a .5 cent lower at 9.29 per bushel, but that's kind of interesting too, because all the other months are anywhere from fractionally to as much as 2 cents higher. So that's kind of a mixed affair going on too. Cotton, we have December cotton down 23 points today at 94.09 cents per pound. I am joined in studio by Mr. Chris Swift of Swift Trading.
Good morning.
Good morning.
Yes, sir.
How are you?
I'm well.
What do we do with a market like this? It just drives everybody nuts right now because it chops around and doesn't get anywhere.
Well, right now, actually, it's pretty good because if you think about the harvest time coming up, we know we're going to have plenty of inventory regardless of what USDA states we are or will not have on our yield. We know that we're going to have more inventory coming. So just not being down 10, 20 cents when I wake up on Monday mornings is a pretty good indication that that there's still some support up underneath there. But clearly, last week's USDA numbers changed the dynamics of the corn crop. It makes every single bushel now that much more critical.
Well, and that puts a little added pressure on the Pro Farmer Crop Tour that's going to be starting today and going through the Midwest here over the next few days. And we're going to be getting live reports from that tour, by the way, each noon Central Time, I believe. And I'll have to check on that time. I think that's correct. We'll be getting live updates. But that tour does have a potential, does it not, to maybe move this market one way or another?
Well, and it can, especially when they go to the garden spots of the east. There's lots of space that that will clearly beat the largest yields that we've ever had. But those are few and far between. But if they do go up into that northwest quadrant where we believe the majority of the damage is, that's when I think you'll see the yields, kind of bring back down. And it's the only thing without any kind of harvest data. It's the only aspect that I can see that would have changed USDA's mind would have been that northwest quadrant is worse than what they either anticipated or worse than what the garden spots of the east are.
Just real quickly, were you more surprised by USDA dropping their yield by 5 bushel an acre on the corn, or by the fact that they trimmed their usage?
Well, I think the drop in the acreage is the biggest deal, because generally in August you have no harvest data to go by. So historically, I think the last 6 or 7 years, the trade guess has been well under what USDA has come out with. And so now USDA has come out under what the trade expectations were. I think it's a pretty big guess to the market.
All right, we'll come back in just a moment and we'll talk with this guy right here, Chris Swift, about our livestock trade on a Monday when we come back. Thank you so much for joining us. We're talking with Chris Swift of Swift Trading, and he's based right here in Nashville. You've been in Nashville for quite a while now, haven't you?
All my life.
All your life?
All my life. I'm one of the few natives.
And you do like to focus on livestock trade, right?
I sure do, yeah.
Now, what led you to that?
Well, a lot of different things. But when I very first started out in the business, one of the older brokers was generous to me. And he said, if you're ever going to make it in this business, pick a market, learn everything that there is to know about a market, and then go after clientele in that market. So I had acquired a cattleman and really enjoyed the way that he did business. And they were very familiar with an auction atmosphere. They had to trade feeder cattle, they had to trade fat cattle, and they had to trade corn. So there was 3 markets in general that they were always trading, unlike a grain farmer that can store grain for months on end.
Well, let's see if the excuse me, live cattle can perk things up a little bit today. Grain market has been kind of weak in the knees right now on the live cattle. All right, Chris, make sense out of this. We have the nearbys higher. You have October 62 higher now at 128.75, but you have the deferreds for next year 22 and 30 cents lower on February and April, respectively. So that would seem to indicate what they would call bull spreading, correct?
Well, it's a little bit, yes.
Yeah. So what does that mean? What's that trying to tell us?
You're trying to entice inventory to keep coming into the market. Anytime you offer a premium for something into the future, you're attempting to entice to bring that product into that time frame. So we've got, if you think back months ago when we look at the August contract now, we didn't have great big huge placements during the time frame of April, May. So now we're living with that with a little bit fewer inventory for the slaughter for the August. But what we find out is we still don't have the slaughter capacity that was needed. We've seen for the last 3 months a little bit lower on feed number, and we would think that would gain us a little bit of leverage, but with the packing capacity as it is, we still can't gain any leverage.
And with the beef cutout values the way they have been running, just continually higher all the time and big gains every day, that tends to support the nearbys too. And there it is right there. That's Friday afternoon's choice up almost $7 yet again at 324.83. Let's see what the feeder cattle market is doing this morning here, Chris. And feeders are lower, even though the corn market is lower. I'm intrigued by this. September down 82 at 162.25. Why?
Well, I think these are all new contract highs. We're very, very close to it. On Friday, we saw most of these at contract highs. So small price declines like this are just coming off contract highs. So they're not really that bothersome. And we've seen the index kind of soften just a little bit. It had been very aggressively moving higher over the last several weeks. Now, last week, it started to soften just a little bit. And as the seasonal time frames change and we move lesser inventory out of the north and we begin to move more inventory out of the south, those price differences between the two should begin to weaken the index a little bit.
And let's look at lean hogs on the big board. They are showing triple-digit gains all across that board, led by October, up $1.67 right now. So big gains in that hog futures complex. Well, thanks for coming in, Chris.
Absolutely.
Good to have you in again.
Always a pleasure.
Chris Swift of Swift Trading. Tammy, back to you.